The information in this episode is current as of the date recorded and is not intended as financial, tax, or legal advice. You should consult your tax, financial, and/or legal advisors before implementing any transactions and/or strategies concerning your finances.
Hello, everyone. My name is Derek Doyle. I'm an associate advisor here at John Ullman Associates at the Rhinebeck office. In today's video, I'm going to walk you through a blog I wrote this month titled The K-Shaped Economy. In December of 2025, the Federal Reserve cut interest rates by 0.25%, bringing the federal funds rate down to a range of 3.5 to 3.7%. This was the Federal Reserve's third rate cut of 2025, signaling a shift toward monetary easing. Despite lower rates, stock markets are near all-time highs, home prices continue to rise, and gold keeps setting new records. So how can parts of the economy feel strong while others seem to struggle? First, let's dive into what's the Fed's role in these current conditions in the economy. The Federal Reserve's role is a dual mandate: to keep inflation under control and also maintain a full employment. Their inflation target is 2%, and full employment typically means anywhere between 3.5 to 4.5%. Today, inflation sits around 2.7%, and unemployment's around 4.6%. These numbers show an economy that looks okay on the surface, but the underneath story is a little bit more complicated. So what is the K-shaped economy? The K-shaped economy means different groups move in opposite directions within the same economy. One group benefits and grows wealth, and another group falls behind and struggles. This trend became especially visible after the pandemic. High income and asset owning households recovered much faster, while lower income households and non-asset owning households continued to feel the pressure after the pandemic. During the pandemic, a key thing that happened was that the Fed expanded the money supply by roughly $6 trillion. That's about a 40% increase in a very short period of time, which is historically unusual. This measure of the money supply is what we call M2. M2 includes cash, checking and savings accounts, and other highly liquid funds, meaning they can be turned into cash extremely quickly. With so much new money in the system, it had to go somewhere. Much of it flowed into stocks, real estate, and gold. So why does this not help everyone equally? Owning assets benefited the households who already had owned them. And another key factor in this whole M2 supply situation is the velocity, aka how fast the money is moving throughout the economy. While M2 increased, the velocity actually dropped sharply after the pandemic. That means more money sat in investments instead of being spent on goods and services. Asset purchases don't directly increase GDP, which if you purchase a stock or a house, it's not really contributing to the overall economy. This helps explain why financial markets look strong while everyday affordable things feel strained and still under pressure. So I know I mentioned a little bit about the housing, so let's dive into mortgage rates and the overall housing market. Even with the federal rate cuts, mortgage rates still remain around 6 to 6.5%. That's because mortgage rates follow the 10-year Treasury, not the federal funds rate. The 10-year Treasury has stayed between 4% and 5% for roughly about a year. Housing faces a major structural problem, and that is supply. Estimates throughout the US indicate that we are short anywhere between 2 to 5 million households. Limited supply plus excess liquidity in the market is contributed to what has driven all these asset prices up. The impact on home prices has been extraordinary. Historically, home prices have rose anywhere between 3 to 5% per year. During the pandemic, some areas saw 40 to even 50% increases in just 5 years. These rapid increases are well above historic norms, and consumers in the broad economy are still adjusting to this historical shift. Again, homeowners benefit while first-time homebuyers face major barriers into being able to participate in the market. So in the blog, I addressed what can be done during these kind of historically unusual circumstances that we face in the economy. Well, the solution isn't to stop participating, it's to start earlier if possible. Our financial system rewards participation in not only the markets, real estate, and long-term investing. For families with accumulated wealth, gifting strategies can be extremely powerful during this time, helping with a first-time home down payment, funding a 529 educational plan, supporting your charitable causes. All these can extremely help during times where we see asset prices extremely elevated. You want to take advantage of a time like this. Now would be the time to maybe explore some of these strategies. So kind of to recap, a K-shaped economy highlights the growing divides, but it also highlights some opportunities. Planning, participation, and strategic support can make a real difference even in some of the more unusual historic times that we've seen. Working with a qualified financial advisor can help you navigate uneven economic conditions, coordinate family and gifting strategies, and take advantage of long-term wealth building opportunities.
Thanks for watching. If you found this video helpful, give it a thumbs up and hit that subscribe button so you don't miss future updates. Looking for more insights like this? Head over to our website at jgua.com for additional resources. And if you'd like to talk about your personal financial goals, we'd love to help. Just click the Schedule a Meeting button highlighted on your screen to book your complimentary consultation. Thanks again for joining us. We'll see you in the next video.